another reason why people leverage private, sometimes res, but definitely on the commercial side is that, like you said, the banking institution is going to factor in loan to cost as well as loan to value. Whereas private lenders often just want to look at the value of the property, if they can get a direct comparable or if they can see enough income cash flowing and they get an off market deal for $1 million, but the appraisal showing 1.3. You can lend some value on that appraisal, right? Like obviously you always want your borrowers to have skin in the game and to have incentive to get in and get out a year down the road or 6 months down the road. But that flexibility is another reason why private lenders sometimes win out on these deals.
Thanks for tuning in to the Canadian Private Lenders Podcast, the show about starting a private lender in Canada, the mortgage industry, and the real estate industry. Your hosts are Neal Andrino and Ryan and Neal. Enjoy.
All right, everybody, welcome back. It's episode 50 of the Canadian Private Lenders Podcast, presented by our sponsor, Mortgage Automator. It's your hosts, Ryan and Neal. Neal, another round number, man.
That's crazy. 50 is a lot.
50 is a lot.
That means it's almost been a year.
That's right. Yeah, we're 2 away from a year. We're doing weekly eps.
Wild.
This is, it's pretty cool.
Very cool.
Yeah, and appreciate everybody who's supported us at this point. I've had more people at recent events kind of mention the podcast to us, which is really cool. We've obviously had some pretty great guests that have come on and maybe elevated the show a little bit, which is really cool. So, if you are listening, please do continue to support. Give us that 5-star review if you don't mind, and keep following the show and spread the word.
100%.
What are we talking about today, Neal?
Today we're covering commercial versus residential mortgages.
Interesting one.
It is, because there's some funniness in the name. Sometimes a residential property that holds residential, what we would call that residential spaces, can hold a commercial mortgage.
Absolutely. And like, this is one that like people ask all the time. Do you do residential or do you do commercial? And it really depends. It depends on what your definition of res and commercial is, right? And we're going to go through that today and kind of talk about the differences as they're defined in Canada. But I think specifically in the private lending space too, there's kind of some nuances there that differ between the two. And, where we think we may be doing a res mortgage, someone else may deem that as commercial. So I think we can go kind of in detail on that as well.
It has some relevance too. I mean, we won't get into it today, but just when you look at the MIC and how the funds are structured, there's rulings on what portion of funds can be
exactly
allocated towards commercial versus res. So that's also it's also felt like a bit of a gray area.
Yeah. And so just to expand on that, the Income Tax Act defines that mix have to hold at least 50% residential holdings in terms of the dollars under management, right? So, but I've looked into that a bit further, and anything that is zoned residential would qualify as residential, right? So that could still mean a multi-unit that would a bank might deem as a commercial mortgage. Am I right on that?
Yeah.
I think.
And it's interesting to me because in my head, like private is so heavily focused on res mortgages, but that's my experience being here in Atlantic. But I think that just shows across Canada and the privates in like BC and Ontario, they're heavily levered on the commercial space,
right?
Whether that be like office towers, warehousing, or like commercial land. So,
but even beyond that, and I think we're maybe getting ahead of ourselves a bit here, but if you're looking at a rental portfolio of residential properties or something in a holdco, many lenders would say that's a commercial mortgage now, right?
True.
Whereas we'd be like, well, depends who you ask.
depends who it's for.
Let's go through it here, Neal. So basically, we've touched on it already, but we're going to break down the fundamental differences between commercial and residential mortgages in Canada. We'll cover what sets these apart, who typically uses them, and some important financial metrics specifically for commercial deals.
Yep.
Okay. So Neal, why don't you define residential mortgages for us?
Yeah. A residential mortgage is a loan used to finance a personal residence, single family home, a condo, or a duplex. These loans are generally based on the borrower's personal finances. Small multi-units also typically qualify as residential. Small, I would say, is sub 4 units.
Yeah.
Maybe sub 5 is what they used to have it on the CMHC website.
Yeah. So why don't I just jump right into commercial mortgages, because this kind of clarifies it a little bit. So commercial mortgages are mortgages for properties used for business purposes or to generate income, like offices, retail spaces, and multifamily residential buildings, 5+ units is the kind of the typical definition in Canada. These loans are assessed on the income potential of the property.
Yeah.
Right? Which is a key.
Yeah, I don't know if we're going to get into that right now, but that's a major key, because I actually having this conversation with someone yesterday who was trying to determine also if they're buying it in a corporation or if they should buy it personally.
Yep.
And how that was going to impact things. And so this is a big part of it, and that's the income potential. And we'll get into that further.
Yep. So I'll go back. I'll do residential side for the lending piece here. So for residential mortgages, these are provided by traditional banks and credit unions, as well as private lenders for borrowers with unique situations like, and specific to private here, like bridge financing, self-employed, new to Canada, flips. We've talked about this before. But again, res mortgages are typically funded by traditional banks and credit unions primarily.
This is, I feel like, what 90%, maybe not 90, maybe 90% of consumers would know.
Yeah.
This is what you see when you see an ad on TV or on the internet. All those rates that you see posted, those are all res mortgage rates.
Yeah, your TDs, your CIBCs, RBCs, and if you're on the mortgage broker side, your First Nationals, your Home Trust, your Optimum, all these lenders here, primarily residential focused.
Yeah. With commercial mortgages, it's also heavily played in by the institutional lenders, but it's in a very different space. You're not walking into the branch to get it. So you'll still get your banks and your credit unions who offer commercial, but typically they have a full separate department like commercial lending. And that's honestly a lot of times those big buildings that you see downtown that you're like, that's not a branch. There's a lot of them are based in there. And then private lenders also play a role. Again, they get really involved in the complex, fast moving, changing type projects. And to what I said earlier, it's something that you see, I think, in some of the bigger cities in comparison to Atlantic. But as time goes on here and things get bigger, I think you're going to see a lot of it in Atlantic as well.
Seeing more and more of that come here now for sure.
Yeah.
And more, I'd say commercial lenders are present in the market here than I've seen in the past.
Totally.
Which is quite interesting.
And they're continuing to come.
Yeah, absolutely. So let's go into loan qualification. So on the residential side, very straightforward, based on personal income, credit history, and debt to income ratio. So very simple. They've got their scorecard. You've got to fit in the scorecard if you're applying at a bank or a credit union, and your valuation is going to be like comparables in the same neighborhood, if at all possible, if you're in an urban area.
Yeah.
Right.
The only thing that gets maybe potentially added in there as well, and there's like every bank's got their own little ratio on how they do it. If you're buying like a duplex or a triplex, they'll add in rental income on top of your personal income. But they might add in, like, some of them have a rule of like 50%. So if you are buying a duplex and half of it's rented for $2,500, they'll add $1,250 a month onto your income. Some of them are now doing 80%.
Yeah, lenders are all different in that space. Some of them want rental properties, some of them don't want, and then the ones who want them typically are a bit more lenient on how that income is calculated into the ratio.
Yeah,
and some lenders don't want to use it at all.
Yeah,
right?
Yeah, exactly. And there's some that won't even touch. To your point, if it's not fully owner occupied, they're not doing it.
Exactly.
Now in commercial, it's completely focused on the income generating potential. And the two metrics that they're looking at is there's a cap rate and the DSCR, debt service coverage ratio. Cap rate, which I don't know if we ever talked about in an episode, but I did on Master Keys. But this measures the expected rate of return on a commercial property calculated as the net operating income divided by the property value. Yeah. So it's the capitalization rate is, again, the return that you see on your money. And that does not include the mortgage pay down and additional potential appreciation, but what you expect to make if the property runs properly. Debt service coverage ratio, which is what they're really, really looking at. The cap rate's a good way to know compared to an interest rate, but the debt service ratio is what they want to know about. And that's the ratio that measures the property's ability to cover its debt payments. Mm-hmm. So we have on here a DSCR above 1.25 is typically required by lenders. So that means if your debt payments or debt obligations for the year are $100,000, they want to know that you're netting at least $125,000.
Yep.
And so, we have on here property generates enough to cover 125% of its debt obligations.
Yeah.
I'm going to add a little asterisk in there that because you can get mortgages insured commercially, if you can get them insured, you might be able to get that down to 110% or 1.1, but you have to get approved with a CMHC mortgage. And kind of the funny part with it is they have additional expenses that they add in. So it's almost like they have a more realistic calculation for debt service. So you may, let's say, make $125,000 based on a regular bank's valuation. CMHC will bring it down to 115. So realistically, you're getting the same debt coverage, but their qualification ratio is lower.
Yeah, I'm glad you mentioned that. And obviously there is other scenarios where you can get, a 1.1 or a 1.2 debt service coverage ratio. I know a lot of credit unions are a little bit more lenient on that, and we'll look at a 1.2 or even a 1.15 in some scenarios. I've been in the private lending game for a while, and let me tell you, Mortgage Automator is the ultimate software for private lenders. It's been a total game changer for our business. I've scaled 2 private lending companies, and I couldn't have done it without this software. The Mortgage Automator team truly understands the challenges we face, and they're constantly thinking ahead. For example, they've developed new anti-money laundering and know your client tools to keep you compliant with the latest FinTrack regulations, and their platform is SOC 2 compliant, ensuring your financial data is secure. This software eliminates almost every admin burden you can think of in the private mortgage business, saving us thousands on staffing costs. No more manually typing term sheets or tracking files in Excel. So whether you're a new private lender looking for an efficient solution or an established lender aiming to scale up, Mortgage Automator is the solution for you. See if Mortgage Automator could be a good fit for your unique lending needs at www.mortgageautomator.com/switch. But I wanted to go back to the cap rate, Neal, just for a second, because I'm assuming a lot of people who listen to this are primarily focused in the res space.
Yep.
So can you walk us through how NOI or net operating income is calculated?
Yeah. So your NOI is based on, you have your gross rent, and you can also do it on an annual basis. So say you got 2 units, $1,500, you're making $3,000 a month. So it's $36,000 as your gross annual revenue. Then you'd have all of your expenses for the year. So you'd have your property tax, your insurance, your property management. And then this is where banks are going to start adding these in. And they're things that you wouldn't necessarily think of because they're not formalized as an expense, but you'd have vacancy, maintenance. They even have like a heat pump allowance in there now to cover all the potential expenses that are going to come up as time goes on. They'll usually even put in maybe wages, advertising expenses. They'll put all the things that you're actually realistically going to incur. And so let's say that totals at $15,000. We said your gross annual is $36,000. All your expenses or $15,000. Your NOI is $21,000. So keeping in mind that they are not factoring in at all your mortgage costs. So there's no mortgage interest or mortgage payment within that. So they then take that $21,000 and that's what they use to figure out how much mortgage you can get. So let's say they divide that by 1.25 because you want to get 125% of your mortgage payment. So you could probably service around $17,000. And so $17,000, let's say $1,500 a month is what it'd be able to cover.
Cool. And what would a standard cap rate be? And let's use Greater Halifax as an example on like a small multi-unit.
So
I know it's just changing every day.
It's changing every day, and there's some weird purchases that go through, and it's because people see opportunity for upside. But for like a stabilized building in the downtown cores, people are paying as low as, let's say, 4.5, maybe even 4.25 for a nice, brand new, beautiful building. And then as you start to go further from the core, that'll appreciate. So if you're looking at like wood frame in good condition, you're probably closer to like 5.75 to 6.
Okay.
And then as the property maybe deteriorates, you can be higher, 7 or 8. But I would say expect to be between 5 and 6 on average.
On a newer product?
Yeah, on a clean product.
Cool. All right, let's quickly touch on interest rates and down payments here. So on the res side, typically residential rates are lower or more stable rates, often fixed, although you can do variable as well. I'd say traditionally residential rates are, most commonly in Canada, 5-year fixed rates. Although with the rate fluctuation in the last couple of years, we've seen a lot more 3 or less year fixed rates that people have chosen just to kind of wade the navigate the waters that we're going through now with rates. And down payments on the res side as well typically range from 5 to 20%. Now, we've touched on this before, but anything below 20% down payment does require CMHC insurance on as well. Yeah. So that's a consideration. It's an additional cost that would roll into your monthly payments as well. And if you're 20% or above on that down payment, you don't need that insurance as well. Yeah. So it's something to consider on that side.
Totally. And on that same consideration, when you go CMHC insured, you might save a bit on your actual mortgage interest rate to help offset some of the cost associated with the mortgage insurance.
Yep.
So then, looking at the commercial side, the rates are typically higher than res, and that's reflecting increased risk, right? The idea is with a res purchase, they're expecting that you're usually owner occupying it. People are less likely to foreclose on their home than a business owner is to let go of an ill-performing asset. So because of that, commercial rates are typically higher, and they can vary based completely on the type of property, whether it's industrial, office, res, retail. and then also where it's located, the financial strength of the people within that, especially if it's commercial and they say like, okay, you have a Home Depot, like that's going to be like a grade A tenant versus maybe some random startup company that they have no backing or like history of payment.
One really interesting thing I find in the Canadian space is that there's a lot more discretion available from lenders on the commercial side versus res. Like res is very much in the box.
Yeah.
And there's no judgment, if you're in like the most rural area of Nunavut versus like being in Halifax or downtown Toronto, if you fit in the box, they got to approve that mortgage, right? Versus commercial is completely and much more similar to alternative lending, I'd say, in where there's a lot of discretion there.
I think the res side is like that because government's kind of mandated that there has to be fair market for everyone. So people aren't just like, well, because I live outside of town, I have a great job, but the bank just won't approve it because I don't like the neighborhood.
Can't be biased to someone's their living accommodations.
Yeah, exactly. Right? Whereas commercial, it's a business thing. So the government hasn't stepped in and been like, you have to follow these protocols. And to that point, associated with it, there's often again more risks. So they expect a lot more money down. And the minimum is typically 25%. There's sometimes on some small res deals, you can get that down to 20, but honestly, 99.99% of the time, it's 25% or more. And in the last 12 to 18 months, it's probably been more like 35%, if not as high as 50% down. And that's simply because the rates were high enough that the income on these properties could not suffice it. And I want to quickly step back to cap rates on that. With things trading, like we talked about, on average between 5 and 6 cap, very quickly. So think about this: you're making 5 to 6% return on your property. If you're fully leveraged on that, and commercial rates are as high as 7 to 8%, you're no longer making any money. So you can't even service that debt. And so there's a lot of risk associated with that. So the bank is going to, and just you physically can't service it, they're going to expect you to pay it down way more to get them on the right side of it.
Yeah.
This is something that why a lot of people were concerned about the valuations in the commercial marketplace, because it didn't make any sense. You were literally losing money to own this property.
Yeah.
So yeah. Anyways, that's I'd say a big difference there. And again, also why a lot of people, when they ask if should I incorporate in my first property, blah blah blah, like, nah, you're jumping the gun here because you're gonna have to put so much money down. You're gonna have additional costs on your rate, additional costs on your insurance. It's not always worth it.
Yeah, absolutely. Okay, so let's talk about types of mortgages here. So on the res side, I already touched on this, but fixed and variable rates are very common in Canada. Terms typically in the 5-year range or less, and the amortization period traditionally has been around 25 years, although that is changing now with more 30-year AMs available.
Yep.
Neal, commercial side?
Commercial side, they also offer fixed rate and floating rate mortgages. Again, typically a little bit higher in price. They also have specialized loans like construction loans or occupancy target loans, basically where, in a construction loan, you hit certain percentage completion, and they'll give you additional funds to continue the project along until you're fully complete, where it might turn into a regular term loan at that point, or you may have to pay it out with a new loan. Additionally, in an occupancy type situation, once you hit certain occupancy levels, they may release further draws. So you might buy a property that's approved at $5 million, but because it's only 50% occupied right now, they give you $2.5 million. When you sign a tenant in 2 months, they give you another $2.5 million.
Yep.
And so yeah, those loans are designed to fund development, large projects. Typically on any of those construction loan or occupancy based loans, those are short. It's usually maybe 24 months, 36 months.
Okay.
And then after that, you can go to a longer term, like a 5-year or a 10-year type fixed situation.
Is that like once it's stabilized, you mean?
Stabilized, yeah, exactly.
Okay, got it. Yeah. Okay, so let's flip over to, let's talk about the role of private lenders here from both sides. So, and really, it's kind of a gray area, I guess, because they both, there's both qualifying criteria that fit both sides. But specifically on the res side, private lenders help borrowers who may not qualify for traditional financing, offering flexibility and speed in their approval criteria. Mm-hmm. And we touched on this already, but it could be anything from standard first mortgages on a purchase and refinance. I'd say most MIC private lenders in Canada, their primary focus is first mortgages, maybe second mortgages, and they want to do purchases and refis. Okay. And there's other lenders out there, like us, that have a wider product offering. They'll do those bridge loans, they'll do construction loans, which, those may be deemed as commercial in many areas. They'll do those flips, those renovation type loans, multi-units. But I'd say in general on the res side, the most common one would be your standard purchase refi, first and second mortgage.
Yeah. And it typically is a speed thing, I think, for on the res
Absolutely.
side.
Speed or income restriction because of some irregular income,
True.
self-employed situation where the bank just says, sorry, but you don't fit our box.
Very true.
Yeah.
On the commercial side, it's typically more complex. And I'd say one of them, from my experience, is construction.
Yep.
A lot of banks don't want to get involved in the construction process. Like, they're like, we'll happily finance you on this retail plaza once it's complete, but we don't want any part of it. And if you're not carrying a ton of cash, or it's honestly, if you do the math, it's not worth your money to have it completely tied up in this project. This is where a private may come in and allow you to get it put up. It's also, again, quick funding. There's less restrictions. And so it allows you to get the development completed and in a timely fashion. Sometimes too, depending on the commercial property, there might be a huge uplift that some of the more traditional banks might not be interested in. Like, sometimes you can get a residential plaza tilted up for $1 million, and the rental income that it draws actually values it at $5 million. And if you go to a traditional bank with that right off the hop, they're like, no, we're only going to give you the lesser of the cost to build it or the appraisal. And you're like, well, it's appraised for $5 million. Like, what did you build it for? And you're like, $1 million. They're only going to play with that $1 million number, even though it might draw a massive amount of income.
Yep.
So this can give you an opportunity to get it built, stabilized, and get that huge lift and kind of be able to pull forward some of your equity.
I'm glad you brought that up because I didn't have appraisals in our notes here. And that's a really good point. When another reason why people leverage private, sometimes res, but definitely on the commercial side, is that, like you said, the banking institution is going to factor in loan to cost. As well as loan to value, whereas private lenders often just want to look at the value of the property, if they can get a direct comparable, or if they can see enough income cash flowing, and they get an off-market deal for $1 million, but the appraisal showing 1.3. You can lend some value on that appraisal, right? Like, obviously, you always want your borrowers to have skin in the game and to have incentive to get in and get out a year down the road or 6 months down the road. But that flexibility is another reason why private lenders sometimes win out on these deals.
Totally. And I think, to your point, like, creativity is a big part of it. I know I was chatting with another private, and they did a big deal on a portfolio. It was mixed across 2 provinces, super low debt ratio. It serviced the private money, like, no problem. But I was like, why'd they come to you? Like, they've been in the game for 1 million years. And he's just like, well, an opportunity came up that they wanted to operate or move on quickly. And for the institution to go through like 30, 40 properties over multiple provinces would have been such a drag on. They wanted construction reports. They wanted this, that, and the other thing. And he's like, these are all prime locations. We were at very low loan to value, and they debt service that the private capital is. So it's a no-brainer versus them having to battle with whoever they were going to battle with to get all these reports and documents and spend 6 months getting a loan approved.
Exactly.
So anyways, that's where our privates really start to shine.
Yep, absolutely. So closing thoughts here, Neal. So choosing the right mortgage, whether commercial or residential, depends on the property's use and the borrower's financial goals.
Yep. Understanding metrics like cap rates and DSCR is critical for commercial mortgage decisions. We've rambled on that for a bit, but yeah.
Yep. And just to summarize here, so always consult, a knowledgeable lender or mortgage broker to ensure you're selecting the best product for your needs. If you don't have a mortgage broker contact, reach out to us. We're more than happy to make an introduction to one of our many great partners. We've got a lot that specialize in res, a lot that specialize on the commercial side. So always happy to make those introductions. Anything else, Neal?
Get doing deals.
Keep doing deals. Let's go.
Thanks for listening, guys.
Thank you.
Hey guys, it's Neal Andrino, your co-host and your co-founder at Keystone Capital and Director of Investor Relations. I'm also a real estate agent, real estate investor, and business owner.
And your co-host here, Ryan McNeil. I'm the co-founder and president of Keystone Capital Group. Keystone Capital Group is licensed under the Mortgage Regulations Act of Nova Scotia, license number 3000549, and through FCMB, license number 88799. And keep in mind, the views of this podcast are for informational purposes only and is not financial advice.